If you're looking to prepare cash flow forecasts with credit sales, in other words, where your customers take time to pay you, be it 1 month or 2 months or 3 months or whatever payment terms your customers have, our cash flow Excel template has this feature built in. So in this example, I'm going to be just looking at ABC Construction Limited. There are no figures entered at the moment, so I'm going to put some numbers in there to show you how easy this is to do. But first of all, I'm going to set the beginning period. So I'm going to say this is starting from the 1st of December 2017. I'm then going to go to the data sheet, and you can see the first column is December 2017. So I'm going to put £5,000 in there. At the moment, the terms are set to 0. So if I go to my profit and loss account, it'll show me £5,000 in my turnover. It's pulled it through automatically. If I go to my cash flow forecast, it will show me receipts of £5,000 as well. If I go back to my data sheet and change my payment terms to 1 month, so in other words, my customer now takes 1 month to pay me after I've invoiced them. If I go to my profit and loss account, of course that hasn't changed because the sales made in December in the same month as before. However, if I go to my cash flow forecast, that's automatically moved the receipt to the following month because the customer takes 1 month to pay you. And this feature allows you to set those payment terms anything up to 12 months forward. Let me just demonstrate again. Let's say 4 months, which I know is a long time, but it gives you an example of how easily it is to change it. So if I go to my cash flow forecast, you can see now that the £5,000 has been received 4 months after the original invoice was raised. The other complexity, just to quickly cover on this video, is if VAT comes into play with your business. So what I'm going to do, I'm going to change this to 20%. And as a quick aside, VAT is a sales tax. So if in your country it's not VAT, it's sales tax or GST, which I know it's called down in Australia and New Zealand. You can change this heading to that. So I've now put in 20%. So just to quickly confirm, on the profit and loss account, it's still £5,000 because of course that's shown as net. However, on the cash flow forecast, it's still showing as £5,000, but that's because I haven't switched this on. So let me just switch. I'll set that to being paid quarterly. Now my cash flow forecast, the receipt has increased to £6,000, and that's because it's added 20% to the £5,000. So it's not only taken account of the fact that the customer's taken 4 months to pay, it's also taken into account that when the customer does pay us, they pay us inclusive of VAT. The other thing to quickly mention is, of course, at the end of the month where you've raised the invoice, there's an amount owing from that customer, and that gets reflected on the projected balance sheet. So if I look at the month-by-month projected balance sheet, you'll see that trade debtors at the end of December, because the customer still owed us, January, February and March, is showing us £6,000. And then in April, that has been cleared and the money's been transferred to the bank account. There are other things going on here because, of course, the cash flow forecast takes account of the VAT. So here we can see that there's the VAT creditor, i.e. the £1,000 on top of the £5,000, which is showing as a VAT creditor. So we just quickly pop across to the cash flow forecast. We have the receipt of £6,000 from the customer, but we've also got the payment of the VAT, which in this case is paid quarterly, so it's paid 3 months after the invoice was raised. So initially, the bank goes into overdraft when the VAT is paid, but quickly returns to credit when the customer pays us in 4 months' time.